Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. Today we're going to cover the 4% rule and ask the question, is it dead or is it in serious jeopardy? Why are we asking this question now? Well, it's because the Wall Street Journal came out with an article, and I'll tell you, if you just focus on the headline and a couple of first paragraphs, you think it's all over. We might as well just give it up. The 4% rule is gone. Let me just show you the article. Here it is. Cut your retirement spending now, says creator of the 4% rule. Now, before I dive into the article, a couple of things. The headline, in my view, I love the Wall Street Journal, incredibly misleading. You'll see why in just a minute, partly because when you read the article, it's actually pretty much the exact opposite of what the headline says, so there's that. But there's another interesting tidbit in this article, and that is the creator of the 4% rule, Bill Bengen, has taken almost his entire portfolio to cash. If he's jumping ship, should we? That's what we're going to cover in today's video. Let's get back to the article. Just want to touch on the first couple of paragraphs just to, instill fear in everybody. For decades, retirees have relied on the 4% rule to determine how much was safe to spend in retirement. Now the rule's inventor says current market conditions may require an even more conservative approach. The combination of 8.5% inflation with high stock and bond market valuations make it difficult to forecast whether the standard playbook will work for recent retirees, said retired financial planner Bill Bengen, who first devised the 4% rule in 1994. So, what's going on? Well, if you read the whole article, Bill Bengen says, look, we are living in unprecedented times. We're going to look and actually decide for ourselves whether we think that's true, but that's what he says. Unprecedented. We've never lived through times like this, and therefore that whole 4% rule based on 50 plus years of data going all the way back to 1926, throw it out the window. We don't have a clue what's going to happen. Yeah, you can kind of sense in my tone I'm a little irritated by this whole story. Of course, yes, it's true. We don't know what the future will hold, and anything is possible. But should we really run for the hills, terrified that the 4% rule will fail? Well, first of all, when you dive into the article, here's what Bill Bengen actually says. He says, the 4% rule, which I wrote about in 1994, that's when he first published his paper. He's written about it many times since then. He said, I've actually updated the asset allocation. In that original paper, I just looked at two asset classes, S&P 500 and intermediate term treasuries. And he said, since then, I've added and looked at a lot of other asset classes like mid-cap stocks, small-cap stocks, micro-cap stocks, international stocks. And when you use a diversified portfolio and the right stock bond allocation, well, it turns out the 4% rule, it's really the 4.7% rule. It actually says it in the article, 4.7%. And what does that mean? It means that based on his more recent research, but again, using historical data back almost 100 years now, the absolute worst time to retire, you still could have started with a withdrawal rate of 4.7% and then adjusted each subsequent year by the rate of inflation and had your money last at least 30 years. 4.7%. Now, when was that horrible time when you could only start with 4.7? Well, turns out it was October of 1968. We'll come back to that. There's a reason why that was such a bad time to retire. And interestingly enough, it doesn't have anything really to do with 1968 itself, but more on that in a minute. In the article, what Bengen now says is, maybe you want to be a little more conservative and only start with a 4.4% withdrawal rate. Yeah, so when I read the headline, I'm thinking, boy, not 4%, what is it? 3.8, 3.7, 3.5? No, it's actually higher. It's 4.4%. Yeah, that Wall Street Journal headline, kind of tricky there, huh? I invite you to read the article for yourself, and I will leave a link to it below the video. So what we want to now look at is, before we get to why he's gone to cash, are we really living in unprecedented times? That's kind of, number one. And I think as part of that, we can look at 1968 and the years that followed it. Why was that such a terrible time to retire from a financial perspective? So with that, let's first look at, we're going to look at two things. Stock market returns and inflation, because those are the two levers. Those are the two variables that can either sink us in retirement or propel us to, a glorious 30 years of, golf or fishing or crafting, whatever you do. Stock market returns and inflation. Let's start with stock market returns. And of course, there's no way to predict the future, but what folks look at are valuations. And the standard valuation they tend to look at is the PE ratio of the S&P 500. Now let's just stop there. Is that the only thing we should be looking at? I mean, if we follow a diversified portfolio like Bill Bengen is now recommending that includes mid-cap and small cap and micro cap and international, many if not all of which have lower PEs than the S&P 500, why are we so fixated on the S&P 500? Well, I don't know, but that's what everyone seems to be fixated on, so we'll just, follow along. And the starting point is this chart. This is the Shiller PE ratio. It looks at 10 years and adjusts it, but looks at 10 years worth of earnings. And you can see the PE ratio right here, it's about 35. Now, that's not the highest it's been. So no, we are not in unprecedented times, at least not, I guess theoretically. It hit that point right before the tech bubble. But I suppose you could say still, okay, Rob, but still, barring that one period, leading into the 2000 time period, we kind of are in unprecedented time periods, at least based on the Shiller PE ratio and the way he calculates it. But what if we cut the S&P 500 in half? What if over some period of time it lost 50%? Well, we'd be right back in the middle. We'd be, we would no longer be in unprecedented times. And that raises the question, if the S&P 500 went down by 50%, again, over some period of time, would that kill the 4% rule? Well, I don't think so. Why is that? Well, we can look at the historical data. This is the S&P 500 price performance. This does not include dividends. It goes back to, right here, 1928, and it goes through the current 2022. And you can see there are plenty of times when we had massive losses. Of course, the biggest one, 4 years in a row following the Great Depression, we're down 12%, 28.5%, 47%, and 15%. And guess what? Notwithstanding those terrible losses, the market ended up down 90%. That wasn't the worst time to retire. Remember, that's 1968. So are we really living in unprecedented times? Well, I suppose, every time period is a little different, but unprecedented? No, I don't think so. And in fact, there are other periods. This year we lost 40%. This is 1937. If we lost that this year, certainly that would take the Shiller PE down to, I'll call it precedented levels maybe. And we can look here, 39, it was down 5%, but then down 15, then down 17. Big losses. Same thing here. So are we really in unprecedented times as it relates to stock valuations? Well, again, if you just focus on the Shiller PE, I suppose the answer might be yes. But when you take it a step further and ask, well, what would it look like if this came down and to more reasonable levels? Well, it wouldn't take unprecedented S&P 500 losses. We've seen them many times over the last 100 years. So that's the first thing. Stock market returns and the current valuation. The second angle is inflation. We're at 8.5%. One, is that unprecedented? And two, this is where we go to 1968 in that time period. Very, very important. So let me show you that. And we'll begin right here. This is inflation data by year. Goes way back in time, probably further than we need to. If we started, it goes to 1929, but that's fine. And of course, you notice here there was deflation at the start of the Great Depression. But what I want to show you, there were certainly high years, 1941, of course, that was Pearl Harbor, 2 years in a row where it was at 9%. But let's go to 1968. Remember I said that was like the worst time to start investing? Well, I mean, it wasn't terrible, 4.7. It's 8.5 now. The problem are all of the years that followed. Let's just look at them briefly. 6%, 5.6, 3, 3, 8.7, 12.3, 6.9, 5, almost 7, 9, 13, 12, 9%. We're talking a decade of inflation that was well above average. And that's why it made the mid to late 1960s a bad time to retire financially. It wasn't because 68, for example, was such a terrible year. It was the following decade. So, yes, it's true. If we have a decade of 8.5% inflation, I think there's a very good chance the 4% rule could become the, I don't know, 3.9% rule, 3.8% rule. Or if we actually use Bill Bengen's 4.7% rule now, maybe it just becomes 4%. But it could certainly be lower. But we don't have any reason to believe right now that we'll have a decade of high inflation. Now, I know some would say, oh, Rob, no, I think we will. Look at the government and how much it's spending and printing money. I get it. I hear you. And is it a risk? I suppose it is. Could we repeat the 1970s? I suppose we could. Do we have any reason to believe one way or another right now for sure? I don't think so. And in fact, if you then go back and we look back at performance, if we sort of layer onto that inflation data, stock market data, you'll see that there were a number of bad years in the 70s. 73 and 74 were a really bad bear market. We had 11% loss in 77, almost a 10% loss in 1981. But these losses in the stock market certainly are not unprecedented. We saw much worse in the 20s and 30s. We've seen just as bad or worse this century as well. And so what's the takeaway? Inflation is really the big issue. The stock market's going to go up. It's going to go down. We know that. Inflation is the real killer. It's the thing that we should keep our eyes on. But at least at the moment, I'm not running scared for the hills because we have 1 year of 8.5% inflation. Maybe it's because I'm still old enough to remember inflation in the late 70s and early 80s. Now, having said all of that, going back to this Wall Street Journal article I showed you, and I'll link to below this video, Bill Bengen said he's pretty much gone all to cash. 70% of his portfolio is in cash, and you think, well, wait a minute, Rob. Bill Bengen, he's now the 4.7% guy. Even given what he thinks are the unprecedented times we live in, he's still at 4.4%, and he's gone all to cash. Should we run scared as well and go to cash? And all I can tell you is that I'm not doing that. Now, I do think every situation is different. Bill Bengen is currently 74. By all accounts, from what he said, he has plenty of money to live on, and he can make those kinds of decisions if he wants to, if it helps him sleep at night. And it's probably, from what he says, not going to wreck his retirement. What it is going to require him to do is time the market. And he said that, and he even in the article said, yeah, it's probably not a smart thing to do. It sounds safe at the time. Stock market's generally going down. We know bond interest rates are going up, causing bond funds to go down. I've had many people email me about B&D being down whatever, 8-9% this year. S&P 500, of course, is down so far for the year. But timing the market, I think, is not a long-term approach to either building wealth or sustaining your money in retirement, because if you pull out now, even putting aside the tax consequences, it's going to require you to figure out when in the world do you get back in. And I think that's a very, very, very difficult thing to get right. And remember, you've got to get it right both when you get out and when you get in. And then if you do this regularly, you're going to have to get it right over and over and over again. So Bill Bengen may have gone to cash, but I didn't, for whatever that's worth. Of course, you have to make your own decisions. Well, that's my take on, is the 4% rule dead? No. Could it die at some point in the future, particularly if we have a decade of 8.5% or higher inflation? Sure, it could be lower, but we don't know that now. And I think we're a long, long way from that reality. If you have any questions, leave them in the comments below. I'll be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.